Okay, so we'll do two chapters today, chapter 9 and chapter 11. Uh, and your final exam will open this this Friday, and it will end on Sunday or Monday. And you can take it anytime between that date. We'll only have chapters 8, 9, and 11 on the finals. Same thing, 25 multiple choice. And the day you take the final, please submit your final assignment. Uh, uh, and if the Dropbox link is not working, then you can email it to me. Uh, Please put in the subject line that it's a 315 final project with your name on it. Okay, so let's start. It will start this Friday or Saturday, and it will end on Monday. So you can take it between any time, between Saturday and Monday. Okay, let me share this. Okay, so let's start with chapter 9. So this is again an extension of chapter 8 that we did. Um, this one deals with confidentiality and privacy controls. Uh, there are a few questions from this on the exam. So biggest issues companies face right now is a problem of how to maintain confidentiality and privacy of the client's information. Specifically, when you go for shopping, anytime you go a shop and you use your credit card, uh, your information is out there for anybody to look at. And anytime you open a bank account, anytime you log into your email accounts, anytime you open a new credit card account, you have to give them all the information. So even if for opening Facebook, you have to give a lot of information out. So companies have to have a strict policy of maintaining confidentiality and privacy of their clients. So the biggest thing the companies have is protecting confidentiality and privacy. And this sensitive information is, your name, your home address, your social security information, your phone number, your age, your medical history. When you get employed, you have to give out a lot of information, including your medical history. And again, that's a privacy policy issue that the companies need to maintain. So what they need to know is how much information that they can access and what information they can get from you. How can they store this information? How can information be classified as something that can be given out and something that cannot be given out? An employee can choose to opt in and opt out of information. It's the same thing when you have your credit card information. There is something called as an opt-in and an opt-out. So in the US, the policy is as soon as you open an email address or any kind of an account online, or if you open up a bank account or any other account, it's an automatic opt-in. And that's a federal law. That means they can use this information and they can collect any information about you and keep it with them. And sometimes they can also use it to sell it. But there's an option called as an opt-out. It's the same thing as you can unsubscribe on your email from getting any spam emails. And that's a process where you have to go to a bank or a credit card and tell them, I want to opt out of this information. That means they can no longer keep your personal information with them or sell your information for business. Most companies make money by selling your information to a direct marketing company. That's why, in your spam, you get all these emails about buying stuff. And they don't get that information directly. They get it from a legit source. For example, if you open Google, a Gmail account, Google uses that information and sells it. And they tell you when you sign up with their email system, in one of the many thousand lines that they have, somewhere they have an option of an opt-in, opt-out thing, where they can use that information for making money. And that's how they make money. So legally, they are allowed to do it as long as you give them permission to do it. And you permit them to do it when you sign up on anything. Apple does the same thing. So you have to specifically tell them not to use this information. And if you get those when you start a credit card, or if you get a bill from a credit card company, you get a little booklet, and in that booklet somewhere there is an opt-in opt-out information given to you, and you can use it, and you can cancel your information being sent out to anybody at any time. So again, so it's a very important thing for companies to have, because this is your information, this is your personal information, and somebody else can access it. So companies have to give specific policies on how to access that. In the accounting department, when you start working, you will be working with the 401ks, you will be working with the retirement plans, you'll be working with their medical accounting information. So you'll have a lot more information about somebody else than in some other department, except for the HR department. So you will have to sign something, it's a confidentiality signature that you have to sign, that you will not give out this information, or will not share this information with anybody, not even people not connected to this one, even your friends. You cannot give out this information. There are issues when the CEO, for example, is dying of some kind of illness, maybe cancer. Companies are not allowed to give out that information because it has a significant negative impact on the stock price of the company until it becomes very late. For example, for Steve Jobs, it took a very long time for somebody to reveal that he had cancer. Not until the very last moment people were told about that, and they also found a replacement for him. And companies have insurance against that. So if the CEO happens to die, then they can give this information to the insurance company, but the insurance company cannot reveal that information. So that's all privacy and confidentiality problems. To keep your information quiet, there is something called encryption. So everything you type on the computer, even when you do accounting, financial entries, journal entries, making ledgers, and doing financial statements, none of that information is stored in a regular English language. It's changed into something else, which we'll look at when we go through the slides. But that's called an encryption process, and that's very important, especially when you have a credit card. When you swipe a credit card, companies need to change that into some other language that nobody else can pick up. And so controls. So everybody needs to have, these are kind of controls that the companies can place, controlling what kind of information goes out. Digital watermarks are same thing as watermarks on printed papers, where you need to have a company logo or something behind, and that tells you that this is coming from a source which is reliable, and you can open it, and you can only open it if you are allowed to open it. All right. So again, those are confidentiality thing, and then you will get a lot of training on this one every 6 months. That's required by law. So let's look at these. So these are your privacy principles. It's called as GAAP. It's not the accounting principles, but these are privacy principles, generally accepted privacy principles. And every company needs to sign this, which is required by law again. If the companies don't sign it, it's in a violation. And sometimes the companies can stop, they won't be allowed to operate as a business if they don't sign these and follow these principles. So these are the principles that you have, 10, 11 of those. And let's go over them one by one. So management. When you sign up for something, for Google, for Gmail, they have to have a policy in place of how to manage these confidentiality and privacy principles. They have to tell you. Nobody reads them, but when you sign, all that information is given there, and they will tell you exactly what will happen if the system gets hacked into, and how your information is stored, and who has the rights to look at your information. So that is the management. So companies need to have proper management policies with them, and this notice is given to you and given to anybody else that's using your information. So that's the notice. You should always maintain these privacy policy notices. I know nobody reads it. I don't read them. When I buy something online, all I do is click it and buy it without reading any notice. But that's those lines are given, and you can read it. Choice and consent, and that's what we were talking about: opt-in versus opt-out. So you by default are opt-in, and you can choose to opt out, and they can only then use the information if you give them permission to use it. As long as you are opt-in, they don't need your permission, because you already in that notice signed that you can use my information for anything and everything. um, so you can opt out from that. In other countries, for European countries, there is an opt-in situation, where that means they're an automatic opt-out. They cannot collect more information than needed, and they cannot use it for anything else unless they ask permission for you. So it's a reverse thing what we use here. um, so again, be careful with where you sign and what website you're going to, because they can use that information for anything. So collection, only collect needed information. So companies should be mindful of only collecting information that they need. In most situations, when you open something, they ask for a lot of information. It's the same thing as buying a home. They ask for a lot of information. So even opening a Facebook account, a LinkedIn information, or any other online social media information, they will collect a lot more information than needed. And they can get away with that by giving you a notice. And as long as you have signed on, they can collect anything and everything. Use and retention. So how long can they? How will they use this information? Again, they can use this information to sell it, and it will state that in that notice again that they will be selling your information. um, and they can retain this information as long as they want. uh, you can close an account, you can close a bank account, you can close your email accounts, but they can retain this as long as they can. um, Sometimes it's even for years. It's the same thing, like the IRS. If you have filed with IRS, there is no statute of limitation, and they can hold your information as long as they want. Access is more important thing. So access would be who has an access, or who can access your information. How can they review that information? How can you delete that information? uh, and this is on both ends. So the companies who has an access is defined in that notice, and for customers will also have access on their private information. So you can always change your privacy policy at your end. Disclosures to third parties, again, they can use this information and give it to any third party. This is normal in case of lawsuits. If something was to happen, Twitter is very strict about this. So if you have a Twitter account, and if you tweet something, uh, and uh, and if somebody wants your information, that a tweet that has caused a lot of problems, if the court sues Twitter, Twitter can give out your personal information, because they can hold your information, so they can disclose any information at any time. Security is, every company should have security system, anti-hacking softwares, antivirus softwares, firewalls, or any of that. And so they should have good policies. Although most companies that tell you they have good policies really don't have very good or high quality of security system that they want to have, because it's very expensive. And how to enforce that? So the companies have, they have constant customers coming in, constant customers leaving. They need to keep monitoring and enforce these policies over and over again. And they should always maintain compliance. They should also maintain a line for a hotline, which is now required for complaints from either the employees or from the customers. And again, so they have to, as long as the complaint is regarding these policies, you can always go ahead and complain, and they have to respond to you. Any questions? So most of my questions for this exam, for your finals, are from this slide right here. Okay. All right. So an encryption is a software, a system in which which is a preventive system or preventive control that prevents anybody from reading unauthorized emails or information that they should be reading. And especially in the accounting department, if you work for a multinational company, or even with the IRS, uh, when you file your information online, they have to have a system in which your information, such as your personal home address and other information, can be stored in such a way that nobody can read it, and that is called as encryption. And it's a very neat software. What it does is it changes, and again, encryption software should have a key, which is as strong as possible, longer the better. It's the same thing as your passwords that you use for your emails and logging in. So it's a system where you run a software and it changes your plain text and converts it into some other language which nobody can read. It's called a ciphertext. And so I have a multiple choice question or true or false question based on this. So basically it will, you write something, you run this software, it will change it to ciphertext, and anybody that has a key for this software can again do a decryption on this one, that is changing it back into your normal language or a plain text and read that. So only people with that key can either do an encryption or decryption of the software. And there are two kinds of keys that somebody can have, a symmetric key or asymmetric key. So symmetric key is very commonly used. This is very, very simple. You have a key and the person you're sending has a key, and they both have the same key. That means it could be a series of numbers that you have to enter. It's the same thing as DocuSign. If you sign something online, a DocuSign is a system where they send you a contract to sign, but when they send it to you, they run a software, and before you can open it, they give you a password, and you enter that, and then it opens the document, you sign it, and you send it back to them. So that's called symmetric key, where both the sending party and the receiving party have the same key. All the sending party has to do is write that email, run that encryption software on the email system, and then it changes into some other format, and the only person that with the key can open that, and nobody else can. You shouldn't be sharing those keys with anybody. Then you have an asymmetric key. Asymmetric key is for a very, very sensitive information, and normally it has two keys. One is a public key and the other one is a private key. So public key is known to everybody in the company. So if you are the CEO of the company sending private information to all your employees, nobody other than the employees can see that, and because everybody has that public key. But you don't want every employee to see that, only some or few employees to see that. Then you add another layer, which is a private key. And although the email goes to everybody, although everybody has a public key, only people with the private key can view that email. And normally this is done when you have very sensitive information going in and out, such as bank account information for companies, pricing information, budgeting information, private information about mergers and acquisitions, and something that cannot be made public. So anything that is very, very private is sent using an asymmetric key. Asymmetric key, it adds another layer of your preventive controls. Any questions? I have used both of these when I was working. We used to send basic information. If there was a client information that was basic, such as profitability for a client, we use symmetric key because every person in the accounting department needed to see that. But then if I had a report that I had to file, and only the CFO or the controller of the company could see it, I would use an asymmetric key, and which I would send that email out because it's a common email. It's sent to all the accountants, but only the person with the private key, which is the controller or my boss, the CFO, would see it, and they would then send me another email using an asymmetric key if there were any changes made. Okay. So again, you will have a question or two on symmetric and asymmetric key. Symmetric key is very quick. So all you do is run the program and it sends it out. In asymmetric key, it takes a while because you send that email, you do a public key, and then you need to also create a private key. It's created every time. So nobody has that private key. It doesn't remains same. So when you create that private key, you have to send another email somewhere else to send to send that private key to that person. Okay. Another neat software that I've used is called the VPN. It's called a virtual private network. And it's the same thing as remote access, where you can remotely access your work computer sitting anywhere in the world. And in my first job in accounting, this is what I would do, because we were constantly auditing and going to from location to location. But all I had was my laptop. But most of the information was at a server in a central location in some other city or some other country. And we would use this software called as a VPN. It's same thing as a remote access, but more. It has more security added to it. Um, and what it does is you have to log into your computer, then you have to log into the VPN system. It uses the internet, but rather than go through the regular World Wide Web, it goes through a personal site where you enter a key, uh, and it's a separate key, encryption key, where you add that key and you can then start working. And it's very personalized. So if I use my key, only I can read that information. Nobody else can read that information, and then I can start working remotely. I would make the journal entries while flying on the plane, hundreds and thousands of entries just working on the plane, using VPN, because we were constantly working. It was a busy time, and if you needed to go somewhere else, and you're in flight and it's a 10-hour flight, all you do is keep working using this VPN. So you're at work while not at work. Very, very neat software. So my thing is, even if you get a hardware, a laptop from work, the hardware itself is not that expensive, maybe $2,000, but the software, including VPN and the encryption software and all the stuff that you have, um, are very expensive. VPN alone is $10,000 software. Plus the encryption software and all that will add $20,000-$25,000 software on it. So if you happen to lose that laptop, you will end up paying for not only the hardware but the software part of it, because all of this is customized software. So every laptop is customized for the person using it, and only you can access that information. So if you lose it, you have to re-buy a license to use those software. So again, it's very expensive, so try not to lose it. Okay, any questions on the privacy and confidentiality controls? All right, perfect. So let's go to auditing using computers. So auditing is, let me explain this very, very simply, what auditing is. So auditing, if you look at, so IBM is a company. I'm a shareholder of IBM, for example. So I'm connected with the company. But I don't know what's happening within the company, because as a shareholder, I don't go to work every day. I just have shares, own stocks of the company. So there are people in the company that work for me, such as the CEO and the management of the company. So I need to make sure that the CEO and all of the people within the company are doing their job. So I hire a third party, which is independent from the company, and those are called as the auditors. So they are not connected with the company. For example, we have the big four: Deloitte, KPMG, EY, and PricewaterhouseCoopers, PwC, as four big auditing firms, and then we have thousands of other smaller auditing firms. So those are independent from IBM. So they don't work for IBM. So I hire one of these accounting firms to audit the financial statements, to make sure that the management is not committing fraud or there is no error in the financial statements, and the net income or the profit that they tell me is really the profit. So because it's my money that I've invested in the company, I don't want to lose it. So that's called auditing. So these are auditors that audit the company. With the change in the way accounting is done, since everything is done on computer, so we need to have some software to do auditing. And so we audit not only the financial statement, but also audit the software of the company. And that's what this chapter is about. You will learn more about this when you go into 440, but this is just giving a taste of what auditing using computer is. Okay. So this is so again, the auditing is just evaluating and obtaining information about financial statements, that the money that has been used within the company is used for the right purpose, there is no fraud, and that the management is doing their job. Okay, so it's based on some auditing principle. So they audit to make sure that the statements are done according to GAAP. So every statement, every accounting statement should use GAAP. Every journal entry should use GAAP. So we need to, major steps in auditing are planning an audit. That means before the auditors go in, they have to make sure they understand what the client is, because every client is different. IBM is very different from Microsoft, and Microsoft is very different from Apple, and Apple is very different from Google. So every company is different. So you need to do proper planning about the company, because every company has a different history, has a different CEO, different management, different kind of people working, different kind of policies within the company. So you need to know what the company is, how the company operates, who the major competition is, how the industry works, and all that. And your job after proper planning is to go there and look for audit evidence. Audit evidence is nothing but finding receipts for journal entries. So if you have a journal entry for even $1, where is this entry coming from? So you need to make sure that every entry that has been made, every amount that is entered, has some kind of a proof. That's called as collecting audit evidence. Once you've collected all the audit evidence, you need to evaluate. That means you're making sure that the statements that the client has prepared is makes sense, and that you create the same statements as an auditor and compare it and make sure that everything matches. And then once the information is collected, you have evaluated all that evidence, you communicate that evidence or results. So the auditors will create their own report called as the auditor's report or an opinion, and they'll send it out to the shareholders of the company or any other investor of the company. And as a shareholder, then I'll be okay with whatever the company is doing is okay, because the auditors told me everything is okay. Does it make sense? Okay. All right. Perfect. All right. So everything in business we do is risky, right? We invest money, and the biggest risk of in the business is that you lose money. You will get a loss. So whatever we do in auditing, also it has to be a framework that is risk based. That means when we go for auditing, and audit, so if I'm Deloitte or one of the big fours who's trying to audit IBM, I have to see what the risk factors at IBM are, what kind of risk the company would run into. Technology company is very risky because technology keeps changing. So if they use computers, they develop and they manufacture things that's going to be outdated very soon. That's a threat, because the company might not be able to sell it and might lose money. So you need to identify where the risks are. Uh, there are physical risks, such as somebody stealing your product, somebody walking away with all the computers and everything. And then there are logical risks, such as your IT software system. And so you have to have proper preventive, detective, and corrective controls for all this risk. For computer system, you have antivirus software, as we talked about before, anti-hacking software or firewall, whatever you have. For physical controls, you need to have proper lock and key, such as you maintaining control of your laptops. So again, you identify where the risk is more, and as an auditor, you start auditing the risky areas before you audit anything else. All right. So my questions here, and also on this on the CPA exam, these the four things will show up on an exam. The major one is the ITF, or Integrated Test Facility. What this does is the auditors will run fake data through your accounting system, and they'll see how it starts and how it ends. For example, they'll go to the store. If you're Walmart, they'll go to a store and they'll scan a fake item, and they'll see how that fake item goes from getting from that receipt and is filed into a financial statement. So they'll follow that receipt converting into your trial balance. From the trial balance, you're doing your journal entries. From journal entries going into your ledgers, and then finally on the financial statement. So what they'll do is they'll do this fake data running through all the real data, just making sure that the computer is working fine, and also making sure that the accounting department knows what they're doing. So that's called as ITF. Snapshot is similar to ITF, but this is looking at the real data. So they'll look at one file and they'll see how the file changes from beginning till the end. So that's called a snapshot. They'll just only look at the beginning and the end. um, they will not trace the entire flow of information. In ITF, they trace the entire flow of information. Okay, scarf is normally is similar to again ITF, but again scarf is looking at real data, and they not only look at just one entry, but they look at dozens and dozens of entries or thousands of entries, and normally monitoring everything that's happening from start to finish. So ITF is looking at few entries, scarf is looking at all the entries or maybe a significant amount of entries at the same time. Audit hooks are randomly selecting few entries. So they'll just see, oh, I see there's a problem with this entry. I'm going to hook this entry and see how it goes. Normally, audit hooks are used for entries that have significant amounts. So if it's $1 million and up journal entry that you're making, they'll do a hook on that, and they'll see from start to finish where how this entry is used and how is it posted and what these entries are. So audit hooks normally for high amount entries. Any questions? So ITF is the only one that uses fake or fictitious entries. Everything else uses real-time real entries. Any questions? All right, thank you. All right, so fortunately in auditing, you don't have to do anything by hand. Everything is done by computers. And there's something called as CATS, C-A-T-S, and that's a computer-aided auditing software. Um, and what it does everything for you. It randomly selects an entry and you follow the entry. It randomly creates fake entries for you. It does all the calculations, statistical analysis, all the ratio analysis. It creates a report for you and tells you if what you did matches with what the client did, and if there is no big difference, then it's okay. If there's a big difference between what you get as net income and what the client has as a net income, then there's a problem. They need to go back and check more entries. But as long as everything is fine, you don't have to do that. So these are softwares. These are very, very expensive software that the auditors use, and they are all customized for each of the big four accounting firms, and even the smaller firms use them. um, to help them randomly select entries or to help them create fake entries, to help them look for entries that are wrong. And the computer spits out a result, and then you compare your results with the client's results. So again, I don't have any questions based on this, but it's there for your information. And so there you have some. Perfect. Operational audits are, so anytime you see the term operational in auditing or in financial accounting or in your financial accounting exams, operational audits are always about minimizing costs and maximizing profits. So what you want to do in operational audits is to look at the policies that the companies have set up, to see how they can save money, to help them develop a process where if they don't need certain expenses or costs, they can reduce them, and how they can maximize their profits without committing any kind of fraud. So the biggest thing is, you have to make sure that the companies are not creating or performing any frauds or just to increase the profits, because people's bonuses are tied to profitability. So what you're testing for is how good their operations are, how well they can minimize waste. Because a manufacturing company, you are a car manufacturer, for example, and you have doors, windows, all different parts, nuts and bolts, and all that stuff. A lot of things can get wasted, and all that wasted is cutting down your profit because you have to keep reordering them and getting new items all the time. So you have to look at the operations part of it and see that they are not wasting stuff. There is no fraud. Uh, Employees are showing up on time. There are proper time tickets when they're clocking in, clocking out at the same time, or at the time they're given. They're taking the proper lunch and all that stuff. So you're not overpaying your employees, and you're not paying for employees that are not there. So again, these are all part of operational or audits. It's very, very important because you are making sure that the client is using their time and resources properly. Okay. All right, I guess that's that. So consultants are normally CPAs. That's a good question. So uh, consultants that audit are auditors, and these auditors all have to be a CPA. Good question, by the way. Yeah. So all the big four accounting firms, anybody that's working in the accounting firm, when you start working as an accountant for a big four, you don't have to have a CPA. But if you are a senior partner or a senior manager who's signing off on documents, you need to be a CPA. To start working, you don't need to have. You need to have an accounting degree that gives you enough information to be an accountant. Um, but then to sign off on anything, you need to have a CPA license. All right, guys. So we are done with all the chapters. This is our final lecture. Uh, and so your exams are 25 multiple choice based on chapters 8, 9, and chapter 11. It will be open this on this weekend. Take it. Also, yeah, the latest by Monday midnight for the for the final assignment or the final project. It's latest by Monday midnight. And again, as long as you understand everything and as long as things are clear, you get full points on that. So I'm not very strict on that. The idea was to give you a taste of what you have to do when you go and start working. So do you guys have any questions? All right, perfect. So I'm gonna hopefully I've recorded this uh, properly, and I'm gonna post the link on Blackboard. Email me if you guys have any questions, and good luck with your finals. Thank you.